It's sad, right? Not just sad, it's a tragedy. And the problem, the tragedy, is that for the past decade, being smart has not mattered.
All right. It is the Phil Bach Podcast. Thank you for listening. I have a new episode with Ben Hunt coming out in just a couple days, but before I post it, I want to revisit 2 podcast episodes recorded with Ben on my previous podcast, the ETF Experience. I launched the ETF Experience podcast as a tool to bring the conversation around ETFs closer to our business, our products, and our services. Essentially, it was a marketing tool, the softest of soft sells. The podcast I have now is under my own name, and it's not affiliated with my job or any of my ventures. There is nothing being sold to you on this show. And this podcast episode is the reason for that. This episode showed me that the podcast could be used as something much bigger, as a tool for something more valuable, self-exploration, deep conversations with people I admire or people I'm curious about, and a way to really understand the truth and get my voice out there. This was the first episode that broke through that wall. On this episode, we talk about what's happening in the markets, how to retain pricing power in the asset management industry. My favorite moment on the show is when I referenced Ben's idea of government cooperation, and he corrected me that it's government collaboration. It's a subtle difference, cooperation versus collaboration, but it's illustrative of how intentional and thoughtful every word is that Ben writes about. It really blew my mind. So please enjoy. I'll be posting part 2 tomorrow, followed by the new episode, which is part 3 in just a couple days.
The Phil Bach Podcast. Investing, economics, entrepreneurship.
We're going to get out of the ETF weeds for a bit. We're going to take a deeper look at the narratives through which we see the world, around us. My guest today is Ben Hunt. He is the co-founder and partner at Second Foundation Partners and an author at Epsilon Theory, epsilontheory.com and the Epsilon Theory blog. Ben is formerly the chief risk officer and the chief investment strategist at Salient Partners and holds a PhD in philosophy, political science, and government from Harvard University. And to say I'm excited about this show is an understatement. The Epsilon Theory blog, authored by Ben, Rusty Gwynn, and a couple other guest authors, is, in my opinion, the single most thought-provoking resource online today. The writing tends to revolve generally around the economy and the investment industry, but it does spread wider than that. And at Epsilon Theory, they derive stories and they connect dots using what they call the narrative machine. So we're going to learn about that, and mostly Ben has a way of cutting through the noise and bringing well-thought-out, long-form ideas that are unique and iconoclastic. So we're going to dig in on some of my favorite Epsilon Theory notes. So let's just jump right into it with that. Ben, thank you for joining the podcast.
Phil, thanks so much for having me. And your intro, man, I've got to have you come along with me all the time. I'm game. I'm part of the pack, as you would say. So let's start here. So you started off in academia, and then you moved over to the investment side of the business and then entrepreneurship. And that's kind of the full spectrum. And I think this comes out in your writing a little bit as well, certainly in Taleb's writing, the dichotomy between academia and entrepreneurship and how different they are. What was that experience like, starting in academia and ending where you are today? Well, you're right about it being it's a cultural thing. And also, I am an entrepreneur. That's a bug, not a feature. So I'm sure a lot of your listeners are also entrepreneurs, and you're an entrepreneur, Phil. You know what I mean when I say we can't help ourselves. It is a bug rather than a feature. And I was in academia really as a way station. It wasn't my end goal. So I went up to Harvard and got a PhD in, well, they call it government. Everywhere else they call it political science. You know, Henry Kissinger's got a great quote, which is, I think, accurate, which is that every day you're in academia, you are building your intellectual capital. And every day you're out of academia, you're spending your intellectual capital. And so it was a wonderful experience for me. I got my PhD. I was a professor for 10 years, had tenure. And I loved the building of intellectual capital. The issue with academia, as again, I'm sure a lot of your listeners are aware, is it really is antithetical to, I'll call it an entrepreneurial approach. It's a church. It's a church. And that drives a lot of my writings on particularly central banks today, because they have become academic departments in their own right. It has become a church. And so because I had the entrepreneurial bug, I'd started a company in grad school, started another when I was a junior professor at NYU. But then I gave up a tenured spot because if you're an entrepreneur, you have to do it. You can't stay in a monastic cloister like academia tends to be. So I left to start a software company.
It's hard to describe that entrepreneurial bug, and a lot of people ask me, why did you start Exponential ETFs? Why did you start the company? There are different stories depending on the context. There are different ways to answer it, but there is that drive that a lot of entrepreneurs have that it's hard to describe, but
it is hard to describe, right? But it's part of who you are.
It's almost like evolutionary where, I'm programmed. I know that I have to take this leap and I have to take this step.
Were your parents that way?
No, my father's an actuary. My mother was an IT manager.
Same here. It's interesting, right? That the way, in some respect, it's not a rebellion, right? It's not a learned thing. It really is something you're born with.
But my brothers are. I have two brothers, and they're both entrepreneurs, and very different from each other and in very different ways, but they are both entrepreneurs. And we are competitive, to say the least. We are extremely competitive. And that definitely drives me, and that definitely places a chip on my shoulder, a chip that served me quite well, I think, at the end of the day, but it certainly has pushed. And I'd credit that for a big part of my...
Well, Phil, I think that's another thing that I found so constraining about academia, because I'm also a competitive person. And you're right. Every entrepreneur I've met, frankly, is competitive. And I don't mean that in a bad sense. I mean that in the good sense of competition. And certainly there's competition within academia. The problem is in academia, there's no way of keeping score. There's no way of keeping score in that competition. So what it becomes is a competition over who is smarter. And so how do you measure that? And I can remember so many job talks and presentations I'd go to where I'd be sitting there with the other faculty members, and all of us, including myself, we weren't really listening to the presentation. We weren't really trying to learn. What we were engaged in doing was, while the person was talking, we were all thinking, okay, what devastating question can I ask at the end of the presentation to demonstrate that we are the alpha here, the smartest dog in the room? It becomes, I mentioned this notion about building your intellectual capital. It becomes so antithetical to building intellectual capital because you're playing this game. It's just a game for enormously low stakes and without a way of keeping score. So that's why I love our current business. It's also a game. It's a competitive game. It's the most competitive game in the world, the game of markets. And we can keep score.
That's right. Although I would say that score can be kept in different ways.
Oh, for sure. For sure.
Most people will keep score by the size of the wallet, but there are, and it's hard. No. It's hard to prioritize other areas. Like for me personally, I feel like, I'm driven by a need to prove myself and to elbow my way in. Not necessarily to be the richest, but to be taken seriously.
You want to be right.
I want to be right.
Skipping ahead a little bit. So I started the software company, which is a very boring software company, wonderfully so, because we started it right as the NASDAQ bubble burst, started the company in March of 2000. But we did well with it because it was boring software. Sold my interest there, and we can talk the story later about how I got into markets. But it's, when you talk about keeping score in markets, you're so right about it. It's defined differently by different people and by different organizations. There's no substitute for staying, again, I'll say, true to yourself in how you're keeping score. What I found, though, that as a portfolio manager, because I too want to be right, you were saying that's what drives you, there is a tension between being an effective portfolio manager, between managing other people's money and being right. Because so much time, particularly in discretionary strategies, and I think this is part of what's going on in our whole industry, a lot of, or at least in the, I'll call it active management side of our business, there's a tension between being right and making money for your clients. That ultimately for me is the reason why I don't manage discretionary, actively managed money anymore. Because like you, I found myself so wanting to be right, even though being right might not be the best path to make money for my clients.
Let's jump into it because I had a progression here, but I want to stay on this because there's something that you tweeted that I wrote down. Let me find it, which I absolutely love. And you talk about being right. So this is something that you put out after a conversation about MMT. And he said, well, this is MMT for markets. Central banks have bought more than $22 trillion of stocks and bonds over the past decade with zero concern over price, over value, or quality. Essentially, the point being that is what's driving the price. There's not a true up of true price discovery or value to what ends up being the market price. It's impossible for an investor to compete in that environment unless you're just going with trend and market cap weighted. So you continue, you said, this is why value investing and active management have failed you. All of your time, all of your efforts wasted.
It's sad. It's a tragedy because what you have in our business, I'll call it the money management business, is the greatest collection of brain power, I think, in the world today. I think the tech industry might argue with me, but I'll argue right back. And that's largely driven, I think, because of the fact that compensation in our business, asset management, financial, it's an order of magnitude greater than pretty much any enterprise one can go into. And for not just decades, but for forever, the potential for a smart guy, and unfortunately it's mostly guys. I wish I could say it's smart guys and gals, but we know that's another problem that we need to talk about. But the opportunity for a smart guy to be right and make a lot of money for himself and his clients, it's frankly unimaginably large in this business. And the problem, the tragedy, is that for the past decade, being smart has not mattered. Being right, and by right I mean, oh my God, I've spent so much time on this theme or this company. I read every Q and K, and I've talked to everyone. I've done all this freaking research. And it does not matter. It has not translated into superior returns. It is not translated into making money, and it has all been for naught. Then it requires that sort of soul searching among active managers. Do I stay the course? Is this something that reverts? Will it go back to quote unquote normal, where my application of skills and smarts translates into superior performance? Or is this now broken, and do I need to find something else to do, frankly?
My favorite scene in the movie The Big Short,
Yep.
and he talked about it in the book as well, but I thought it was really well done in the movie, was the part where everyone had made their bets and the market was moving against them for a bit. And then all of a sudden we started to see defaults in the mortgage bonds. But the bonds themselves were getting marked up and we're not getting marked correctly in their view. And the bonds were, and there's a thing in finance, if you're being early is the same thing as being wrong. Or you look at the cyclicality. So let's take value investing. You look at the cyclicality of value investing. The question is, well, is it that it doesn't work today? Is it that it'll never work again? Or is it that we're just, this is the pendulum swings back and forth, growth value or whatever those forces are. And it's really just a matter of patience. Like, you're right, you're not wrong necessarily, but until you close out the trade, you haven't taken a loss.
So I think that one of the issues that we have over the past decade is that those lessons you were just describing about being early is the same thing as being wrong is something that a short biased investor, which is the way I'm wired, right? In my hedge fund, I was primarily responsible for the short positions. And I don't say that in a complimentary sense. I mean, again, it's like being an entrepreneur. It's how you're wired. And frankly, I find that short sellers as a group, and I'll overgeneralize here, we tend to be mean-spirited and suspicious. And I'm not saying this in a complimentary way. It's how we're wired. But because it's how we're wired, we know that you've got to be right on the timing. And if you're wrong, you're not going to make money. If you're wrong on the timing, you're just wrong, as you were saying. That has not been the case for long biased or long only managers until this past decade. So until we have the issues, we can talk the systemic change that we saw in markets, I'll say starting in March of 2009, the long only or the long biased investor always got bailed out by time, so that they could be wrong on the timing. That's what a value investor is. A value investor is almost by definition wrong on the timing because you are identifying a value that the rest of the market does not appreciate. And the ability now to get paid for that work existed, again, forever prior to, I'll put the demarcation line at March 2009. Since March 2009, and this has been the hardest lesson, I think, for long only or long biased active managers to learn, is that you can be right on the fundamentals, but you're wrong on the timing. And so you're wrong in your performance. And I find that it's something that short selling managers have wrestled with forever. And I think it's been a tough, not just a lesson, but it's such a hard, because it does go to what your nature is as an investor. It's been hardest of all, I think, on the long biased investors.
If the market is not going to reward people who are doing forensic accounting, people who are turning over rocks, people who are sitting on rooftops with binoculars looking at warehouses, and if that work is not rewarded, I mean, what happens? Forget even about forensic accounting. If we say that there's going to be a disconnect in the market between the price of a stock and the future cash flows, or any any true up to what intrinsic value is. There's a total disconnect if it's all just trading based off the Fed and narratives. I mean, what happens to the future of capital markets? Like, what is it? What are we investing in?
They become political utilities. And that's one of the main strands of what I write about, is this transformation of capital markets into political utilities. And it doesn't mean that long only and active management goes away, because there's such a powerful narrative or story in favor of active management. I mean, look, we all have a bias, certainly I do, and I think almost all of your listeners do, towards what I'll call as quality. The notion that, of course, we should own companies with growing cash flows, a fortress balance sheet, superior management, and we should avoid the companies that don't. That just stands to reason. That's not just a narrative, it's a faith that we have. And it's such a powerful faith, and it's something that motivates humans. We are hardwired to respond to a faith like that. It's not that active management or value investing goes away. It's that it will just be disappointing. Right? It will. And over time, it does change the composition and the makeup of the people who try to make their business with active investing or value investing, if we want to focus on that. And it, frankly, becomes a much grayer, duller place to me. I think it's so important when we think about investing, particularly when we're responsible for other people's money, OPM, that we don't romanticize and act on what we wish were true. I'm not saying it's good or it's bad, what's transforming in capital markets. I'm just saying it is. And we need to approach it with clear eyes and yet still full hearts to make a living in this business.
And that pulls us to Pricing Power, which is a series, a two-part series two-part series that you wrote on pricing power in the financial services industry. So we dampen our expectations from the value that an active manager can bring. Okay, well, we're also in an asset management industry now. I mean, I'm in ETFs, and my competitors are pricing not at cost, they're pricing below cost. I mean, there's a cost to run these things, and you can reach certain scale and offer competitively with where people are, but there's not enough scale for all the funds that are priced to be profitable at scale. There's not enough scale in the world for Vanguard, Schwab, and the 6 others now, JP Morgan, Goldman, and iShares. It just doesn't add up. The numbers don't add up. So you talk about pricing power. You try to retain some sort of pricing power because you think that you're providing something. And in our case, we certainly do. But you break down pricing power in financial services. And so you really break it down to 3: client ownership, intellectual property, and then the third one is really where it gets interesting: government cooperation. Let's talk about those. I mean, let's talk first about client ownership.
Well, I think what you see in our business writ large is that if you're on the product side, which you are, Phil, right? And I've been all my life, the product side, by which I mean, I'm going to devise or I'm going to manage a strategy, a way of managing money. That's the worst place to be in our business today. And it's always the worst place to be in any business that has product and client relationships when you're in a period of extreme distress like our business is in. The place to be from I'll call it intellectual property side the pricing power side here, is to get as close to the end client as you can get, to own that relationship.
Just in the short time, we've seen zero-fee ETFs. We've seen zero-fee funds from Fidelity. And you mentioned online, you said, hey, they're willing to do it at a loss to make money. I mean, these people they're not trying to donate their services. It's a way to bring people in to make money in other ways. And because you don't have that client ownership and because you're on the product side, now that's what you're competing against. And it's difficult. The second thing is intellectual property. Now, let me kind of pause here because we jumped into the deep end of the pool right away. And I want to kind of give you a chance because intellectual property we're going to talk about the narrative machine that you've developed. So why don't we take this moment to say, all right, what is Epsilon Theory? What is Second Foundation Partners? And what is the narrative machine?
Let's come to that as I talk about what intellectual property means in our business of financial services. Because we tend to think of intellectual property as, oh, this is my invention. I invented something. I came up with a better mousetrap for an investment strategy. Frankly, that can still exist. I think, again, we have such a collection of incredibly smart, motivated people in this business that everyone is constantly looking for that better mousetrap that they come up with. I really think that the notion of intellectual property goes beyond building a better mousetrap, coming up with a better product. The notion of intellectual property, in my mind, also includes the story that you can tell around what it is that you are offering to the market. It's not just that I built a better mousetrap. Do I have a sexy story to tell about the mousetrap? And when I say sexy, you know what I mean. I mean something that appeals to the human nature in the case of investing, of fear and greed. Do I have something that I can tell a story about that is special? And what I think we see so much in our industry, and I'll say this again in a very positive way. Let's take DFA. Let's take dimensional fund advisors, right? They have tons of smart people and products that they've developed. They also have an incredibly strong control over their narrative. I would say that intellectual property of a narrative, a story around DFA, is more valuable than the actual products that they've created. So again, I'm saying this in a very positive light. And controlling that story, having a specialness to your story, is at least as important a part of pricing power through intellectual property as the actual product or the actual mousetrap that you've developed. I said this would get into what we're doing at Second Foundation Partners and what I like to write about Epsilon theory. I think it's now possible to actually measure narratives, that it's actually possible to measure what we would call of unstructured data. The words that we hear, the articles that we read, the stories that we are told on CNBC or on an earnings call. There's a technology, it's called natural language processing. I wrote my dissertation in my first book on this 30 years ago. We didn't call it natural language processing back then because we didn't have just the sheer computing power to call it processing. Yeah. 30 years ago, I was hiring undergrads to go and look at microfiche and hand code newspaper articles that I'd have them read. And I'd program a DEC, a digital equipment mini frame, which some of your listeners will remember back that far. What's happened over the last really, I'll say 4 years, has been the ability to apply massive computer processing power to these, frankly, 30 and 40-year-old ideas and white papers that were developed about how one would measure and think about calculating narratives if one had the computing processing power. And now we do. What I mean by the narrative machine is actually applying just sheer computing processing power to solve these questions and the scripts and the code that we were writing 30 or 40 years ago. So that's what we try to do at Second Foundation Partners. What we write about Epsilon theory is now apply this instrument, and it is an instrument. It's like somebody in 1740 handed you a microscope and then said, here's a new instrument. Why don't you take a slide of different things and put it under the microscope and you tell me what you see? And so you take a drop of dirty river water from the Thames, right? And you put it under the microscope because, oh my God, I knew that drinking the water would make me sick, but now I see why. I can visualize, I can actually see the little animalcules, as they called them back then, swimming in the freaking river water. And it's the same way with narratives. We know that we are influenced as human beings by the words we hear and the things that we read. We know it impacts us. We haven't been able to visualize it before. And now that we are, it's such a powerful thing because seeing is believing. And now we're moving even farther than that, away past just visualization and actually systematic measurement to try to measure the behavioral qualities of narrative in the same way that we've been measuring the fundamental qualities of this company or that company for all these years.
So here we go. So now we have insight into the narrative that's being creative, and it gives you tremendous insight, and you can apply that to your writing. You could apply that presumably to an investment strategy in different ways, and I know your clients are. So you have the microscope and you're able to see that the water's dirty. What is the end game? What's the goal?
Well, there are a couple of end games. And so let me use it in the context of the third aspect of pricing power that we write about. So the first was that client relationship, get as close to the client as you can. The second was developing your intellectual property, but understanding that intellectual property is at least as much a part of the story you can tell about what you do as it is the mousetrap that you've invented. The third, I think, crucial factor in maintaining pricing power in financial services or again, any industry where you're under a lot of stress and disintermediation is what I called government. I called it collaboration. We call it cooperation, if you like. And what I mean about tying this together is that we can actually, I think today, measure the narrative that comes from what we call in game theory, which is my field in academia, the missionaries. So we can measure the stories, the words that come out of the White House, that come out of the Fed or the ECB. We can actually track the birth, the growth, the reproduction, maybe the death of the specific stories that they are telling. We can measure this and track it and link it directly to investor behaviors. And what I'll tell you is that we're finding is that there is this enormous narrative, this enormous effort that's being made throughout government, whether we're talking about central banks, whether we're talking about the executive, whether we're talking about the legislative. It's married with an effort from Wall Street that we can talk about later, again, to transform capital markets into political utilities, to say never again to the volatility of the great financial crisis. And the price of that, the cost of that, is to remove the role or the benefit of active management. So what you find, I believe, is that the asset managers who embrace that transition, who describe themselves in those same narrative terms, which are the companies that describe themselves as passive managers, as the
BlackRock.
Exactly. So Vanguard is my poster child. On the flip side of that, these are the companies that describe themselves as catering to the active individual managers, the E-Trades of the world or the like that, oh, you too can trade like a pro. That's a narrative that requires, and I talk about this in one of the notes, the customer acquisition costs for companies that go down that road are factors higher than the customer acquisition cost of like a Vanguard. It is because, I'm convinced it's because, they've created a story and a narrative that is in the case of the ones for doing trading at home, and, it's a story that is at odds with the story that we are inundated with, that we are awash with 24/7 from politicians, which I include central bankers. Our ability, I think, to measure that and the ability to measure how these narratives that are presented to us wax and wane, that's what I think is important about the research that we're doing. And that's how I think it plays out in our business of asset management.
Yeah. And look, the reason why I point to BlackRock is because Larry Fink, and I don't know the date that we air this, but the date that we're recording it today, Larry Fink just yesterday was in the news for advocating that the ECB should purchase stocks broadly in Europe in order to artificially inflate the market there. I mean, just on the surface, it's insane and very self-interested. I mean, so self-interested that I almost respect it.
Exactly, right? And it's all done with this patina of, oh, you, Mr. ECB, you want to do this because this is going to encourage growth in the real economy. I like to think of myself as somewhat of a connoisseur of trickle-down economic arguments, right? But this is the most trickly of any trickle-down economic argument that you can ever imagine. And they actually, Fink talks about it. Reader, the CIO of the fixed income group, wrote an article in the FT advocating this. He's actually got the balls, right? There's no other word for it, to say, oh, yeah, the ECB, you want to do this because it's going to encourage, long-lasting growth because, well, these companies that have their stock price go up, I'm sure they'll invest more in research and development. It's like, are you kidding me? This is your fig leaf you're putting at this on this? It's just, I like to say they're not even pretending anymore.
They're not even pretending anymore.
And that's so the way it feels, both in politics and in economics.
Yeah, and we'll talk about that, about some antitrust stuff that you've written about. But your conclusion in the article on pricing power, what you say in the end was, I thought it was really brilliant. And it really, my instinct is if I see an injustice or a wrong, and I'll include an asset mispricing in that, is to want to take the other side of it, to fix it and to rage against it. But your conclusion here is, the answer here is that you don't fight the Fed, you don't fight City Hall. In fact, the real answer is that you fight on the same side as the Fed, on the same side as City Hall. And then you added what I thought was a brilliant zinger, which is like St. Warren does on taxes. Of course, Warren Buffett advocating for higher taxes. Yeah, I mean, that's right. And I think you recently said something on Twitter where somebody said, well, if there's all this Fed manipulation, all this market manipulation, that's when you just want to go to Bitcoin. And you said, no, that's when you want to go to equities. Right. That's what's happening. It's happening right in front of our eyes. Ride the wave.
So this goes back to our conversation about the difference between being right and about making money for your clients. Because like you, Phil, my natural reaction when I see this, because it is an injustice, it's bullshit is what it is. My natural reaction is similarly to rage against it, to find a way to take a position for when it's going to break, because my assumption is, okay, by God, I'm going to set up a big trade here and this cannot stand, right? It will not stand. That's my inclination. And what I also know in my heart is that that's not the right way to play this for my clients. And I think that goes again at the tension of what all of us, and by us I mean active managers, all right, discretionary managers, what all of us have struggled with over the past decade is that being right, again, has not translated into doing well by our clients. And it's frustrating is too weak of a word. It calls into question the reason why we got into this business in the first place, was that we could be right and do well for our clients and do well for ourselves. And that triad has been broken. I don't think it's coming back. And so what's one do? You either, I think that the way to have been successful over the past 10 years, and I think for the 10 years going forward, is not to fight it, not to rage against it, but to go with it, right, as I'm describing, provided that, and this is the hard part, to not believe it in your heart of hearts. Because I'm still, and maybe this is just my own personal faith, right? I do think this too shall pass. Not to go back to the way it was before. This isn't a mean reverting phenomenon. But I think that one must be profoundly adaptive so long as you're managing other people's money. And that the trick here is not to take these crazy words that Fink and Reader were talking about the other day, and to take them into our hearts. The critical thing is not to look at the emperor who is naked as a jaybird and walking down the street, and not to convince yourself that your eyes are lying to you and to start believing in your heart and hearts that that's a fine suit of clothes he's wearing. We can be in the world without being of this world. It's frustrating, and I wish I had a better advice or course of action to take, but I don't think one exists.
I mean, that kind of brings back to what is the whole point of the narrative machine. So you pull open the curtain and we can see that, all right, all these articles and all these messages and things that are coming at us, the whole zeitgeist, it's all maybe designed or planned more so, way more so than we ever knew before. But that doesn't mean I can do anything about it. I'm still powerless against it. So it's almost like ignorance is bliss. I'd rather not know. There's nothing I can do about it. And just to keep it in our industry, it's gotten so far in that one direction where there are people, there's messaging out there, there's virtue in what BlackRock and Vanguard are doing. They're the virtuous ones. They're low fee. They're giving investors cheap access. And the guy who's trying to understand the value of what he's buying for his clients, the person who's doing that work saying, I'm not going to buy some overpriced crap for you. I'm going to actually understand and run a valuation model and try to have a deeper understanding. That guy is viewed as he's shady. He's the one who's trying to sell you some more expensive product.
You must be a crook, Phil. If you don't understand that low fees are the end all and be all of investment management.
Then you're a crook.
Yes. I mean, really, Phil?
That messaging is out there. That messaging is out there.
Absolutely is out there. Look, if you talk to any investment board, I know you've been in this situation, I have as well. The question that always comes up is one of fees, as it should. Fees are crucially important. And this industry was dominated by absurdly high fees for so many aspects of not just on the product side, but on the trading side and the like. And this tool of narrative, though, is so strong and so powerful for us that the narrative is now that fees are, in fact, the only thing that matters. The only thing that matters. And that's just not true. And yet, do you have an alternative story? Because, see, that's the thing. When a narrative is powerful, you can't break that narrative by fighting it head on. What is required is to present an alternative narrative. And this is true in politics. This is true in markets. This is true in our business. The answer to what is happening writ large with central banks and markets, the answer to what is happening in our business with the narrative domination of the Vanguards and the BlackRocks and the like, the answer is not to fight that head on, to say that narrative is wrong. You will lose that fight. The answer is to create your own narrative that does not attack the other narrative, but displaces it. This is one of the crucial findings we've had from looking systematically at narrative and measuring this. We talk about humans as having short attention spans. We talk about short attention span theater. The better way to describe it is that human beings, we have a limited attention span. We cannot hold 4 or 5 big narrative ideas in our heads simultaneously. We just can't. We're not wired for that. What you can actually see when you measure the narratives, for example, that float through financial media, or the narratives that are created on macro events, is that typically it's the old Highlander TV show, there can be only one, right? Yeah. And narratives have a lifespan. They weaken, they split off, they reproduce. It is possible to create new narratives that grow and over time displace the existing narrative. That's the way forward.
This is really mind-blowing stuff. I really enjoy the writing and the thought process. And I want to leave it here. This is my... I've been doing this final question with every guest. Tell me about an obstacle that you've had in your life or career that you've either found a way around or persisted through.
The biggest obstacle I found, and it's going to get back to that description of what do we personally do about all this? Because I say when I started writing about this, I was in a pretty dark place. And I've come to grips with the fact that there are things I can't change. There are things that I'm not able to fix. That includes things in my personal life, that includes things in my business life, and that includes things when I look at our lives as citizens and investors. And I got to tell you that that's a hard moment. I suspect you've had the same experience. So growing up and then getting into business and the like, we've always been able to fix things. We've always been able to find that solution. And the hardest thing for me was to come to grips, to realization is, I can't fix this. I can't fix this. This is going to be a failure for me. And to deal with that honestly and forthrightly, and to move beyond it, and to then find, again, not just a few dozen other people write this, but to find that this experience of like-minded people who are trying to wrestle with what I like to call a fallen world, a world where our politics are spinning in a polarized fashion, seemingly out of control, where our markets seem to be collapsing into one big black hole that we'll call, Vanguard passive accounts. How do we make our way through that? And the answer is with each other. And I know that sounds idealistic. It's not. It's very real. It doesn't come through a political party. It doesn't come from above. The answer is not to find the answer. It goes back to the 3-body problem. There is no answer. There is no closed form solution. That's the technical term for it in Poincaré's work. There is no closed form solution for what the future holds. What there is finding full-hearted, clear-eyed people to go through this together with. That's always been the answer. And realizing that on a personal basis has been everything for me. And the way that I have found my way through, around, over the biggest obstacle I've had in my life, or the biggest challenge I've had, which is to recognize there are some things I can't fix.
Ben, I want to thank you for joining me on the show for this discussion and for your writing. I want to thank you, the listeners, for your time and attention. And thank you especially to those that gave us a rating. That helps us grow, and I appreciate that very much. We'll be back with a new show next week.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.